The Queensland Government first introduced project bank accounts by the Building Industry Fairness Act, the BIF Act, and this applied to some state government projects from the 1st of March 2018. A review of the framework was then undertaken and various changes were recommended. All of the recommendations were accepted by the government, and as a result, we now have an amendment of the BIF Act. One of the recommendations to simplify the requirements was replacing the existing project bank accounts, or PBAs regime, with project trusts. The new project trusts framework has commenced and has a staged implementation. It will be further expanded from the 1st of January 2022 through to the 1st of January 2023 to include local government and private sector contracts. We'll take you through these changes, including what all these terms mean, determining if you need a project trust account, and establishing and operating a project trust account. So what are PTAs and RTAs? A PTA is a project trust account, which essentially is a trust account where all progress payments received by the head contractor are deposited. You only need to have one PTA per project, and payments are made from this account to the beneficiaries, being the subcontractors. Subcontract payments will always take priority over head contractor payments. If there's a shortfall of funds, this shortfall needs to be met by the head contractor. So it's important to make sure that the account is properly managed. An RTA, or a retention trust account, is a trust account that holds retentions that have been withheld by the contracting party across any number of project trust projects. Only one retention account is required per contracting party, and that can be used across multiple projects. For either type of account, the trustee, who's the head contractor, is not allowed to invest the funds, and they aren't entitled to payment for the cost of administering the trust account. So do you need a project trust account? There are 4 criteria that each contract needs to be assessed against to determine if a project trust account is required, and all 4 criteria need to be met. The first criteria is that the contracting party is as specified for the relevant phase, and the second is the contract price is as specified for the relevant phase. We then get to more than 50% of the contract price needs to be for project trust work, and the last criteria is that there's at least one subcontractor engaged for all or part of the contracted work. Condition 1 and 2 refer to the contracting party and the contracting price for a relevant phase. To see if these conditions apply to your contract, we need to work through the various implementation phases. The first phase of the framework has already commenced and now applies to state government contracts over $1 million. From the 1st of July 2021, the framework was further expanded to include eligible contracts for hospital and health services, also with a contract value over $1 million. From 1 January 2022, project trust accounts will now apply to all local government and private sector contracts with a value over $10 million. From 1 July 2022, this value reduces to $3 million and further reduces to contracts over $1 million from 1 January 2023. When we're talking about the value, we're talking about the GST exclusive price of the contract. So for any contract that you sign, first check the contract date and the amount, and if you meet these requirements, then you'll need to move on to conditions 3 and 4 to see if you need to apply the project trust account framework. The third condition states that you'll need a project trust account if 50% of the contract price is for project trust work. The list of what's included in project trust work is quite extensive, but it includes construction, renovation, alteration, improvement or repair of a building, including all aspects in connection with the building: lighting, heating, water, site work related to any of the above. It also includes contract administration, specialist work by architects, engineers, surveyors or certifiers. The last condition states that a project trust account will only be required if there's at least one subcontractor engaged for all or part of the contracted work. The legislation introduces another new term here called protected work, but stay with me. Protected work just adds some additional items to the previous list of project trust work. So it includes anything that would be considered project trust works, plus works such as roadworks, pipeline, water, mains and drainage, installation of heating, lighting, power supply, water supply, Site works such as earth moving, foundations, scaffolding, site restoration and landscaping, or painting and decorating. As with anything, there are some exclusions, but they're probably as you'd expect. Employees of the head contractor, obviously because employees can't be contractors. Suppliers of goods or materials, where it's only the supply of the goods or materials and they're not being installed on site. Consultants, including accountants like us, and lawyers. That might all seem quite involved, but the best starting point to determine if you meet this condition is to assume that an entity will be a subcontractor unless you can exclude them. More than likely, this condition will be fairly obvious anyway. So that takes us through the 4 conditions, and if you meet all 4, you're in the project trust accounts regime. But again, there are a number of exemptions to be aware of. Contracts not required to have a project trust account or a retention trust account include contracts between the state and a state authority, contracts for small-scale residential construction work. This is where there is less than 3 living units. So for example, a single house is classified as a single living unit. A duplex would be classified as 2 living units, and both of these would be exempt. Contracts for maintenance work, for example, testing, taking samples, any work required to prevent deterioration or restoration to original condition. Contracts for design, advisory work, or contract administration work are also exempt. But be careful with this one, as the legislation is prescriptive about who is completing the work that's exempt. For example, a registered professional engineer or a registered architect needs to be completing the work. Lastly, contracts with less than 90 days until practical completion are exempt. So you've determined that the project trust account framework applies to you. What do you do next? Tom is going to take us through establishing and maintaining a project trust account.
Thanks, Michelle, for helping us work out whether we need a project trust account or retention trust account. Now we know we do, what are our next steps? Practically, how do we go about getting one? And then what do we do once we have them? So the first practical step you should take is double checking and confirming you actually do need the account. Check this with your advisors. Second step, check whether your financial institution, so your bank, is able to open this type of account. They need to be approved by the QBCC. That list is on the QBCC's website of who is approved. There's only 5 approved institutions at the moment, and some of the major banks are not on that approved list. No doubt they'll get there, but at the moment you might have to approach another bank. Once you know which bank you're going to use, request the account with them. You need to have the name of your business and the word trust in the account name. But because there's going to be 1 project trust account per project, you might want to add some extra words. For example, ABC Builders, Trust Account, Smith Street Project. Once you've got the account established, you need to notify quite a few people. The first people you have to notify are the QBCC. There's an approved form you have to use to do this, and it's available on the QBCC website. Once you've notified them, they'll put you on the public register that people can search to see that that project has a project trust account. You then need to notify the people who have contracted you, so the owner of the project who's going to be paying you, and you have to notify your subcontractors as well. There's no approved form to do these notifications, but there are templates on the QBCC website you can use if you so choose. After you do your notifications, you've got to do some training. If you have a retention trust account, there is compulsory training that must be done within a quick time frame of opening the account. This is online training at the moment that goes for 2 hours, and you can register on the QBCC website. There are approximately 5 training sessions per month. In addition to that, you're going to need to train your staff on how to record all the entries and what they need to do in relation to these changes. This is going to be a big task, it's going to be difficult, and there's not going to be a lot of people who know how it works in the first place who are going to be able to provide this training. So that's really one of the practical difficulties that can't be overcome. You just need to start and then ask a lot of questions if you're unsure. Third thing you need to do properly is keep records. Now this is going to be a real challenge because there are no software systems that can cope with these requirements. Everybody knows that there's no systems for this, and I don't think anyone's going to build any. The market is quite small, so you're going to have to set up your own system. I suggest doing that in conjunction with your accountant and advisors and the administration staff who are going to be keeping all these records. Next thing I suggest doing is finding an auditor. These records have to be audited once a year, and the first audit will be 12 months after the accounts are established. Now, you need a registered company auditor to do this. That's what the regulations say, and there are very few registered company auditors, fewer than 400 in Queensland. And what they normally audit is things like listed public companies. So I suggest reaching out, trying to find an auditor early on, and they'll also be a valuable resource in checking your system, making sure they agree that it complies, so that when they come to do their audit, you get a clean bill of health. Final practical consideration is that nobody is going to get this 100% right straight away. Everybody knows that there's going to be issues. It's an all new system, and it's not been copied off a system from a different place. So there's going to be a lot of learning. There's definitely going to be some mistakes. QBCC have recognised this and said that they will factor this into their compliance approach. What they really want to see is a genuine effort to comply properly. So some of the things that they've said that they want to see is that you've made a genuine effort. Your state of mind has been one of trying to do the right thing. What they don't want to see, and what will get you into trouble, is if you try to avoid the regulations or you do something on purpose that you know is not right. They also want to see if there are any problems, the scale of those problems are not too large. So if there has been a breach, how big were the dollars involved, and did anyone lose money? Third thing, how long did any problems last for? Did you fix them straight away, or did you just ignore the problem, let it keep going on, and have a million more mistakes that were exactly the same? And finally, what type of system have you put in place? Did you just ignore the whole thing and hope it would go away? Or did you make a genuine effort to consult with advisors, train your staff, try to do the right thing with the system that you've got? If you've done that, you should be okay. Hopefully those first two modules that we've talked about have given you some assistance, but I think there's a lot more advice that everyone's going to need. You really need to be talking one-on-one with your advisors to understand the effect these changes are going to have on your business. They're going to apply to nearly everyone, and I see two real key changes that are going to happen. One, the effect on your cash flow, and two, the effect on your systems. You're going to need to deal with both of those. As an example of the different system you're going to have, let's think of a builder who's doing 3 projects, and under the current rules, they just have their normal account where all their fees are paid into. Let's take a look in more detail at this 3 projects option. So under the current rules, project 1 is making a loss, and it's run in September. We're going to have to pay our $50,000 subcontractor payment, but we've only got $30,000 to pay it at the time because it's making a loss. What we would normally do under the current rules is when our project 2 monies come in, we would pay those old subcontractors from project 1, and they would be clear by the time we get our project 2 money. Let's say that's in December. We'd also pay part of the project 2 subcontractors, and then when our project 3 money comes in and we've made our profits, we'd clear all of project 2's subcontractors, and we'd still have enough to pay our project 3 subcontractors, so that would clear then. If there was any that was still unpaid, it would be from project 3, and those debts would not be very old. Under the new system, if there's a loss on project 1, we are not going to be able to fund those monies out of money from project 2 if it's a break-even project, because those project 2 monies will go straight to the project 2 subcontractors. If we make a profit, such as on project 3, we'll be able to pay our project 3 subcontractors and potentially some of project 1's subcontractors, but it's still going to end up being those old debts that are outstanding from any lost projects. These are going to have big impacts to everyone. I think everyone needs to be looking to ensure they have sufficient cash, understand their cash flow, and potentially put in place other facilities to draw on extra cash that may be needed. To think about another example, how will retentions work? Currently, if we've got $100,000 of retentions payable, we've still received that $100,000 into our bank account. Under the new rules, we're not going to have that $100,000 in our bank account, and we're not going to be able to use that money to fund any existing work. So I would be talking with your advisors, looking at your current level of retentions, and if you have less than that amount of cash in your bank account currently, this would be a major problem as it stands now and will likely become one in the future. So you need to look at your cash flow from that point of view. Finally, I think you're going to need to talk to us about your record keeping system. The person who's doing these records, receiving invoices from your subcontractors and sending invoices to your clients is going to have to make a lot of changes. It'll be much smoother to have us involved in that process and make sure it still works for your accounting purposes, your licensing purposes, than to just go ahead and let them do something which then causes a problem later on. We strongly advise contacting us now to make sure you not only comply with the new regime, but also that your accounting and licensing issues are under control.